Good afternoon. It's Quant Trade Edge, and I wanted to show you a pattern that's set up today. It's just happened, I don't know, 30 minutes ago, an hour, a couple hours ago. This is a chart of the S&P 500, and I wanted to point out a key level, and that key level was back from the FOMC on the 20th. And this is where the rally started. And you can see that we got a test down there on the 2nd, and we bounced nicely from there. And then yesterday's surprise reversal crashed right through that level, but today we recovered right through that level. So I want you to think back conceptually to the Forex trade. In the Forex trade, we look at when we take out a significant level, which is usually the high of day or the low of day. Here, this being a level that got stuck beneath, now these people are trapped. These shorts are trapped as we went back through that key level. So if you can be flexible in your thinking, it doesn't have to be a previous day high or a previous day low. It can be other significant levels. The nice thing about previous day highs and lows is they're objective. There's only one answer to what that level is. If I asked you what are significant levels, there are a bunch. And, different people will think different things are significant. So, that's kind of where it would become less objective to look at it this way. But with that little bit of discretion, it is, helpful. And, the FOMC level where this massive rally started, to me is a significant level. So if we go back and see what happened today when we took that out, we're down to a 2-minute chart, and this one bar took out that whole range, and we continued to go higher, and then we got a very clean A, B, C. And as you know, I don't like to count hoagies in there. So this is 44.25. This is 44.25. So I guess this is technically a hoagie right here. So I guess from that perspective, this could be one wave down. If we looked at it on a 1 minute, you've got an extra wiggle. Well, no, this is actually all a hoagie there. So you do have an extra wiggle in the 1 minute. So it's one leg down, 2 legs up, 1 leg down. But however you looked at that ABC, this would have been your risk bar down here roughly. Probably a little smaller if you used a 1 minute, this size if you used a 2 minute. And it's a 5-point bar. There is significant range and volatility, but that is a 5-point bar. And 36 to 66, 66 and a quarter, that would have been 6R right there. We typically go for 4R, so that's more of to 56.25. And you could have gotten that between 10:16 and 10:42, so about less than 30 minutes. You would have gotten 4R on that ABC pattern. So I get a lot of questions about the ABC pattern. What is an ABC pattern? When is ABC up, ABC down, etc., etc. I define an ABC pattern as a corrective pattern. So that means we should have an established trend, and then you have a pullback against that trend, and the shallower the pullback, the better. So in this situation, breaking through this pivotal resistance and having this impulse up tells us we're in an uptrend. There are other indicators you can use to help confirm something as simple as a MACD crossover, except that's more what's the word? That's more cyclical. Something like your ADX with DMI. It could also tell you that you're trending. All of these things come from price. So as you get better and better at looking at price, you don't really need the indicators as much to understand that, wow, this is an impulse that went through significant resistance. I'm going to call the trend up. And then when that happens, you buy the ABC down for a move up. And, like for example, right now, this is a trend up. We've got an A, B, C down. And this would be your risk bar. It's that easy to find ABCs. In fact, I like that one. Let me take it. But and then what you can do beyond that is then look for a target, and that the target can, depending on how strong it is, usually 1.272 is a conservative target. And what you'll often see is you'll get a retest of the high, you'll get a weak-looking candle, and then you'll get kind of a resumption to this 1.272. And then there are times where you pull back from there. There are times when you go straight through to the 618. On silver, 618, it's such an impulsive market. The 618 is usually where it goes to. So that's just a word on ABCs and significant areas and how to find the patterns and trade them. And I mean, if you look at this one now, it's had about a 2.75 stop, so 11 points up from here would be 72.50. Okay, so not quite there. 72.50 is between, 72.50 is basically the 4R, where you get 4 times your risk, and it's between the 1.272 and the 1.618. That's reasonable. I love it when you find one where the bar is so tight that your 4R is below the 1.272. I feel like those have a higher probability of playing out. And if the bar is really wide and your 4R is way out of there, you might want to find a way to reduce risk on the bar. Like maybe wait until you can get in at half the size of the bar. And you may miss some because some may not allow that. But that's kind of the trade-off. We always want to be able to make 4 times our risk from our capital that we risk. Otherwise, the pattern we're taking is probably not. We're not being patient enough, waiting for the best opportunity, because there are plenty of opportunities to make this 4 times your risk. So anyway, that's it. A little word on ABCs, and especially ones that come after taking out a significant resistance, which is often previous day high, but doesn't have to be. And good luck with the rest of the day. Don't overstay your welcomes on a Friday. Fridays can zone out a little bit in the afternoon, especially on FOMCs. You can sometimes give back morning gains. Lots of unpredictable things. It kind of becomes a casino the longer you stay on a Friday. There are a lot of zero DTEs, and even the weekly options are essentially zero DTEs. And people can start playing games. The big boys that can move big size there can really start swinging things around. So take your profits and enjoy your weekend, and we'll see you again soon.